I'm Simon Masey, one of the tax partners in Menzies, and work with the legal side of the practice. And today I just want to have a little canter through a couple of tax issues, some structuring issues, some corporate finance issues, and we're going to start with a little bit of revision. Because sometimes we forget to remember some things, and I think actually it's worthwhile just remembering some of those things, because if we go back to basics actually, we can save a bit of money sometimes. As I say at the top there, tax is a certainty. I'm butchering a quote here, tax is a certainty. The amount may not be, and with appropriate professional advice, I hope that we can help you minimise that. So if we start by thinking what the partnership agenda is, what do you as a practice want to do? By this I mean, do you want to have maximise your profits that are shown to the outside world, or do you want to minimise your tax bill? Or, in the case of most people, do you want to maximise your profits and minimise your tax bill? Do all the partners in the practice actually need all the profits that they're generating to live their lives? Do they have substantial commitments in terms of school fees, mortgages, family life, holidays, whatever, that they have to have all of their profits drawn out on a year-by-year basis? Is there any scope, or should there be any scope, or can we create any scope for something to be retained for a longer period? Those are the kind of questions I'm hoping just to at least throw out and maybe get to some conclusions on today. So as I said earlier on, I think what we need to start with is getting our basics right. And it goes without saying, I know, but what you need to do is make sure that the costs you incur are actually tax deductible. And I'll give you a little example, and I'll just put the context here. Income tax rates are on the way up, and have been on the way up over the last couple of years, as is national insurance. Our highest marginal rate of tax is 62%. It's not publicised, but trust me, there is an effective marginal rate of 62% for people who earn between about £100,000 and £120,000. There is, of course, a 50% tax rate above. And if anyone wants to understand how we get to the 60% rate, I'll gladly explain that to you later on. So 62%, if you're in that zone, or even if you're a 50% taxpayer, frankly, even if you're a 40% taxpayer, it's worth focusing on making sure you get the basics right, get your deductions correct, and as big as possible. So I've just said here a couple of points here. Make sure you have revenue expenses that are genuinely deductible. So if you've got some long-term expenditure, if it can be on lease and on favourable terms, in this day and age, that's probably not a bad thing. If you are carrying out some improvements to your premises, are you really doing improvements, or actually are they repairs? Is it worth focusing on repairs rather than improvements so that you get a revenue deduction rather than a capital cost on your balance sheet? So if you've got a capital cost on your practice's balance sheet, then that's only deductible over probably 15 years, whereas a revenue expense is deductible today in the year in which it's incurred. And just on that context, let's say, we're all in these things, if you've got a lease on a property and you've got a dilapidations clause on that lease, and you've got, say, 3 years left to run on it, you know you're going to have to spend the money on the dilapidations. Why not do some of that now, if you've got cash? Why not do some of that now? Because they're going to have to spend it. If you're going to get 60% relief, or 50% relief, rather than 40% relief at some point in the future, or some point in the past, think about it now. It's the timing, it's the phasing, and it's looking at all of that. The next thing is just to look at partners individually, and think, well, are you actually doing the best you possibly can with the available reliefs? Come back to this 50–60% tax rate. Pension contributions, if you've got an effective tax rate of 60%, you put 100 into a pension scheme, effectively the government is giving you 60 of that. It's costing you 40 to get 100 in a pension scheme, if you're in that zone of tax rates. It's free money, really, isn't it? Charitable donations fall in the same way. So I'll give you a little example. Somebody who's say a 50% taxpayer. If you're a 50% taxpayer and you give children in need, as last weekend, you give £80 to children in need. Children in need claim £20 off of the government under gift aid. You sign the form for gift aid. If you're a 50% taxpayer, you claim £30 off the government to deduct that off your tax bill. So children in need have got £100, it's cost you £50. You feel really quite good about that. The children in need feel really good about that. Or whichever charity you want to give to. Menzies Foundation, for example. The other 2 points there, just to cover off very quickly. Qualifying loan interest, make sure you're getting full tax relief for your partnership loans. And if you, for example, haven't fully geared your partnership loans, yet you have a personal mortgage, well, is it time to start talking to bankers about refinancing your partnership loan so you're getting tax relief on your partnership loan because you don't get tax relief on your mortgage interest, your personal mortgage. I accept there are issues with rates of interest, but comparing partnerships with personal mortgages, but it's worth having a discussion with your bankers about that. And family tax planning, quite straightforwardly. I had a meeting with a client the other day, and there was a couple, and one was a 40% taxpayer, one was a basic rate taxpayer. The basic rate taxpayer worked for a charity actually, and actually as a consequence of that they got touched up to pay loads of money into the charity quite regularly. A couple of £1,000s a year they were paying it. And they were doing it in their own name, yet they were a basic rate taxpayer. 40% taxpayer wasn't making any charitable contributions because the other half was doing it all on behalf of the family. So I said, well, why isn't 40% taxpayer making the charitable contributions? So as a consequence of just a very, very simple conversation like that, we'd probably save the family, £400, £800 of tax, that they're better off. So, very, very simple steps by standing back and looking and saying, are we being as efficient as we can be? Family, partnership, contributions, pensions, charities, are we being as efficient as we can be? Are we maximising the release we can? Very, very straightforward things to do. It's not rocket science. Your staff. The focus here, the onus here is actually to try and maximise the profit we make without giving away too much money. And the issue here is national insurance, which is a tax. Despite what anyone tells you, it's a tax. As an employer, you pay 13.8% national insurance on every pound you pay your staff. And your staff, assuming they're only below 40,000, let's say, they're paying 12% national insurance. So that's about 26% that's going in national insurance. So if you can restructure the way they're paid slightly, you can save some national insurance. Employer-funded pension contributions are free of national insurance. So if your member of staff is personally paying into a pension scheme, and you could pay that contribution directly for them, you're all going to save national insurance. You could probably share the benefit with them. The approved mileage rate, up to 45p a mile for every qualifying business mile undertaken, is tax deductible in the business and is tax-free in the recipient's hands. Childcare vouchers, I accept they don't have higher rate tax relief anymore, but it's still very national insurance friendly. Cycle to work scheme, we do this for our staff. It's a cost-effective way of buying a bicycle. Prima facie for cycling to work. Most people don't use it to cycle to work, but it's a cost-effective way of doing it. The government have seen a very, very big take-up on that, and they've trimmed away the VAT benefit of that, but even so, it's still very good. And death in service, life insurance. It's often overlooked as a benefit, but a lot of people love this as a benefit, actually. You can give 4 times salary without anyone batting an eyelid. It's actually a reasonably cheap benefit to give, and it's totally tax. It's not a benefit kind for the employee. There's no national insurance on it, and it's a very, very nice way of keeping people happy. So as I say, it's a way of keeping your profits whilst actually keeping people happy, so you make more money by just restructuring and taking some of the government's money back off of them. The final point there is just you need to bear in mind, and our colleagues at Menzies Wealth Management will be able to guide you through this, the impact of auto enrolment. So this is coming. This is a compulsion for all employers, as you will already know, a compulsion for all employers to actually contribute 3% to employees' pension schemes. So you will actually have another 3% tax effectively on your payroll, and it's going to be phased in from next year over the next sort of 4 or 5 years. depending on the size of the employer. So just bear that in mind, and if you need to talk to somebody about that, Menzies Wealth Management will be delighted to talk through. So we move on. Let's think macro now. Business structure. The context here is, as I said earlier on, income tax rates for those partners in partnerships are on the increase. At the same time, the government, due to wanting to make the UK a more competitive environment for international businesses to come to work to trade in this country, are dropping corporation tax rates. So a few years ago, corporation tax was 30% maximum rate. In 3 years' time, the maximum rate of corporation tax on profits will be 23%. Compare 23% with the 62% we talked about earlier on, and there's a massive gulf in the rate of profits. So we're seeing that, with those two factors, we're actually seeing that really the time is right to start thinking about your business structure and whether actually your current arrangements are indeed appropriate and correct. They may well be, but I think it would be foolish, or remiss rather, to not at least consider the alternatives. And I'm going to talk you through a couple of alternatives that we know and see. There are a lot of other things out there, a lot of other more aggressive approaches out there than the ones I'm going to talk you through today. But I just wanted to talk to you about a couple of things. And the idea is twofold. One is insertion of a company into the structure, and the second thing is the supplementary benefit is to think about how your staff are employed. So as I say, with increasing income tax rates and reducing company tax, how about inserting a company underneath your partnership? So you have a partnership, and that is the client-facing part. Partners are there, and the clients contract with the partnership, or LLP, it doesn't matter whether it's a partnership or an LLP. Owned beneath that, 100% owned beneath that, is a service company. That service company is the place that the staff are employed. It's the place that you have your lease with your landlord. It's the place that you have your photocopy your lease and all the other stuff, all the other costs. So that's the point where all your risky costs are. And hopefully your less risky costs are in the less risky aspects are in the top bit in the partnership and the client partners. The service company at the bottom would have to therefore charge to the partnership for the benefit of providing this service of staff and accommodation and the other stuff. And it would charge at cost plus a margin. Let's say the margin's 10%. So if you've got a practice with 5 million turnover, for which probably half of it's going to be staff and other cost, or no, 3 million of it's going to be staff and other costs, let's say, you've got 3 million of costs going through that service company, plus say a 10% margin, that's £3.3 million of costs being invoiced by the service company to the partnership, it's then deductible. That service company generates a profit, £300,000 in that little example, that's then subject to corporation tax of 23%, 23%. In fact, in that case, it would only be 20% because the number of the amount of the profit. So you've shaved a significant amount off of the profits that the partnership would pay tax on. You then either leave the profits in that service company and build them up until such time as you want to extract them, perhaps when tax rates have come down, or you have a choice as a practice to extract those profits from the service company when the time is right. But you can actually then choose when and how the money comes out of that service company. There's another twist to that that's actually more complicated with transfer pricing, but I'm not proposing to go through that today. If anyone wants to talk about that later, and catch me with a glass of wine. The other benefits about the service company thing are just there, as I say, it de-risks the business. So you take out your staff and the lease and all the other things, so you're actually hopefully managing the risk of the practice and reducing that down quite significantly. It may also help with some working capital as well, as I say, because it may help you. It may well be the place where your working capital is retained at 20 to 26% at the moment, 23 in a couple of years' time, and you park it in that service company. rather than it being sitting in the practice. So it may actually facilitate partner drawing out the remainder of their profits somewhat faster than they would otherwise be able to do. The other thing that's been quite popular is the insertion of a corporate partner. So you've got a three-partner practice, partner A, B and C, very imaginatively named, and you insert alongside a corporate partner, a company. So a fourth partner that happens to be a limited company. All the partners then have the same profit share, and they pay tax on their share. But the corporate partner would be owned, that company would be owned by the partners, and it would pay tax on its share of the profits at corporation tax rates. So if you go back to that previous slide, all partners have, let's say it's an equal partnership, all partners have 25% of the profits, and a corporate partner has its 25% of the practice's profits, and it pays tax on that at between 20 and 26% at the moment. What you then allow, and this is where a lot of people take this, is you allow the real partners, A, B and C, to draw their profits out. And you leave the profits sitting in the corporate partner effectively as your working capital. I do think there's a risk with that, because I do think that Her Majesty's Revenue and Customs might well look at that and say, well, why are you treating real people differently to the way you treat a company? And that's my nervousness about that structure as an advisor looking at it. But it has merits, in terms of there being a commercial reason for having another partner there. And actually, if it does work, if you can do it, and you do actually pay out profits, then it can work in quite a neat way of actually deferring some of the tax you pay on some of the profits. Ultimately, you have to wind that company up to get the profits out, or pay a dividend out to the partners. But it's an interesting way of proceeding with things, and it's one that a number of practices have already thought through. As I say, there are always issues with these things. It's never as straightforward as it always seems. This hasn't actually happened that often yet in the legal world. Frankly, it hasn't happened much in the accountancy world either. But it's another tool in the box, incorporation. So turning your practice into a limited company. Nice way of de-risking your business. And effectively, what it does is it's a mechanism for selling your practice to yourself. So you have a practice worth whatever it's worth, value of goodwill plus the work in progress and assets of the practice, and you sell it from yourself to yourself. And it was subject to entrepreneur's relief, therefore a capital gain would arise at a taxable at 10%. The consideration that you generate by selling that practice to yourself, you would leave outstanding, and you would just draw down over a period of time as a loan, but you wouldn't pay any further tax on drawing that loan down. You've paid your 10%. So you've effectively shifted your tax rate down from possible 50 or 60% down to possibly 10% by incorporating. In essence, it's probably a couple of years' profit you're able to do this with. I do think this has a lack of flexibility, because you've let the genie out of the bottle called goodwill, because you've established a value for the practice. So if you want to keep your practice as a perpetual practice, so you want to then bring in new partners later on, they're going to have to pay full value for their share in the practice. And so it becomes more difficult to sustain that model moving forward. As Victoria hinted at earlier on, with the average age of smaller practices being as it is, then those practices are unlikely to have huge succession plans in place, or good succession plans in place. So this is an interesting way to sell your practice twice. So you sell your practice to yourself, incorporate, and then a few years down the line, you sell the company to a third party, and you actually have two bites at the same piece of capital, both at 10%, and actually you get a chunky amount of money out fairly reasonably. So if you have as a practice a game plan to sell your practice in the next few years, then incorporation as a step on that path is probably not a bad idea. which leads me neatly onto mergers and acquisitions, actually, funny enough. A partnership is actually, subject to what I just said, a partnership is a pretty good vehicle to sell because often the acquirer will be a limited company, particularly as they're going to be consolidators and other vehicles like that out there in the future. So we think a partnership is a good vehicle to sell because if it's a company buying, then it's got goodwill which you can then claim tax relief for against its profits. I was shot down in flames for saying this glib comment last time I did this presentation, which was that I think it's actually documentation-wise easier to deal with a trade and asset sale. Documentation and the whole paraphernalia, it's easier to deal with a trade and asset sale than dealing with a sale of a corporate vehicle, because you don't have to go through as much in-depth due diligence on the history of the company. You're just looking at the assets rather than the history of the company. But some people don't necessarily agree with me, but you guys know better than me on that one. And that's that. So I won't dwell too much on those. I think, as I said at the start, tax is a certainty, we can't avoid it. It is a cost of the business, and I think hopefully I've illustrated over the course of the last 20 or so minutes that there are some ways you can think about managing that cost to your business to improve both your profits and hopefully improve your after-tax take home. Just having some decent professional advice. Thank you very much.